can get started. So for some of you, you guys have probably seen or heard this training before. If you are new, this is definitely a new one. This is a Streamline and IRRRL training. Um, so markets will dictate if we will be doing a lot of Streamlines and or IRRRLs in the very near future, but it is possible. And I'm just going to kind of highlight a couple of things that I believe will be important for everyone to understand. So, open Q&A, please jump in at any time. Please jump in if I'm going too fast. If you have any questions about a Streamline, about an IRRRL, about the system that I'm going to be using, about all of the above. Okay? So we will first start with FHA Streamlines. We have built out an FHA Streamline calculator for everyone. You go into calculators, then you go into sales, and you will have your FHA Streamline and your VA IRRRL calculator here. It works. It should theoretically be spot on. There are things that you can do to help adjust some items, but ultimately, Streamline and IRRRLs are very easy loans as long as you do the work up front, right? The only thing that can be a problem for Streamlines and or IRRRLs is the loan amount being incorrect. If your loan amount is incorrect, it will 100% mess up everything. You will get to closing. The cash to close will be 2 to 3K higher than you originally projected. Next thing you know, you have to go back to the borrower. For an IRRRL, you have to increase the loan amount. For a Streamline, there really isn't a lot of options. So doing the work up front will make the sell a lot easier. Okay, so for Streamlines, first thing that everyone needs to understand is that there is a 210-day waiting period and or 6-month waiting period from first payment date. So let's just say I close a loan on 8/1/2024. Okay, or let's just change that to 8/17/2024. We all know the first mortgage payment of this loan is likely 10/1/2024, right? So can I do a Streamline at this exact moment? The answer is no. You must wait until April 1st to pull the case number, right? It goes off the latter of these two. Here's a very common question I get. Okay, cool. Can I upload the loan right now and start it? The answer is yes. You simply cannot pull the case number. Keep in mind, at Secure Choice Lending, we do not pull the case number. The investors pull the case number. So there is some risk to this concept. The risk being, okay, there is a button that you click with every single investor. That's how processors order the case number. I'm assuming no one here has maybe clicked that button or even ordered that case number. Your processors do it for you. So we will obviously be instructed through the submission checklist to not pull the case number. Please remember, you are dealing with people who may accidentally click the case number, or if it's UWM, they may accidentally just say, take the initiative, go do the case number date. If the case number is assigned prior to this by mistake, yes, your loan is dead. You can no longer proceed. We then have to submit the case number to HUD for cancellation. That will take 3 to 4 to 5 days, and then you have to assign a new one. So again, people need to understand that concept in regards to pulling that case number, okay? So how many months have passed since the original closing date? Please ensure you include the month in between the closing and first payment date. This is very important, okay? So if we did this loan, we would have we need to include the month in between the closing and the first payment date. So that means we got 9, 10, 11, 12, 1, 2, 3. Okay, if it has started in this month, so we are in March, that needs to be included. We would enter the number 7 here. The reason why this is incredibly important is this number will decide what your MIP refund factor is. Okay, so let's just go ahead and let's pick let's do the next sum. What was the total loan amount of the most recent? Keyword total. We do not take the base loan amount. So in this example, let's just use I think most of my examples, I do a $500,000 purchase price. $500,000 purchase price, FHA loan, times that by 0.965. Your base loan amount is $482,500. Okay. FHA mortgage insurance premium is 1.75%. Yes, we know calculators do a lot of this stuff for everyone, but if you don't, you should know it. That is how you will decide what your total loan amount is. You can get your total loan amount from a property profile. You do not, I mean, obviously, if you want, you can go into like Zillow and you can figure out what the purchase price was, right? If you do that, then the purchase price, you can theoretically assess that the borrower probably put 3.5% down, things like that. That being said, it's not foolproof because remember, FHA borrowers can put more than 5% or can put more than 3.5% down. We just know it's very common, so they put 3.5. So you can reverse engineer what the base loan amount is, but you don't have to do any of that. You just have to pull a property profile. Property profile will tell you what the total loan amount is, and then our system will do everything for you. What do we do when we are combining a purchase second DPA? Okay, so that's a very unique question, Lisa. That purchase seconds will not qualify for Streamlines. Streamlines do not allow you to subordinate a purchase money second, not the way it works. So just won't be able to do that. You can then flip that to what is called an FHA rate and term, or you can flip that to an FHA simple refinance. I will break that down at the end, so let's go over that in a second. So as I mentioned, 490 for 943. If you don't know, we do not ever finance cents, right? That's why if you finance cents, imagine what amortization schedules would be. They would be exhausting to finance cents. So we know the base loan amount is 490,943. So let's enter that 490,943. Okay. See how the system did the math for you? This means the homeowner's total old loan amount was 490. This means the homeowner's previous base loan amount was 482,500. System did it for you because all you need to do is you need to get a property profile to get what the total loan amount is. If you don't have access to a property profile, please reach out to help desk. We can get you signed up with a title company and get everyone access to that. I'm assuming everyone has access, but if you don't, just let us know. What does the borrower currently owe on their mortgage? That's simple, right? You can take an amortization schedule or you can ask the borrower for a mortgage statement. I mean, mortgage statement's probably the number one thing everyone should get. I don't know what that answer is on this loan, so let's just go ahead and take 487,500. Borrowers made 7 payments. Obviously, I can get the amortization schedule out. I'm not going to do that on this. So 47, that is what they owe. Okay. What is the borrower's current interest rate? Let's go ahead and pick 725. Is the loan fixed or ARM? Fixed. How many years was the original amortization schedule of the loan? This is important. That being said, it is incredibly rare. And anyone wants to jump in. Has anyone done a 15-year FHA loan in the past year? I have not seen any. Like every FHA loan is 30 years, but technically it is important because with FHA loans, if you had a 15-year term, you cannot go to a 30-year term on a Streamline. Like I think the max edition is 12 years. So you can go from 15 years plus 12 years. You can go up to 27. So you just need to mentally know that if the borrower ever did a 15-year term, they will have to credit qualify if they want to go from a 15 to a 30. Again, very rare. We all know nearly every single FHA loan right now is 30 years. The calculator is not built to tell you this type of stuff. It's just there, right? Just for you guys to know, right? Borrower's homeowner's insurance, I'm just going to pick 100. What is the borrower's monthly taxes? Cool, I'm just going to use the standard tax rate. What is the borrower's MIP factor? Again, this is an important one. This MIP factors, if you don't know, MIP factors are determined by the previous down payment of the old loan. So again, majority of borrowers are 3.5% down. If they are 3.5% down, the MIP factor is 0.55. If they put 5% down, the MIP factor is 0.50, right? So just know that. And then, of course, for anyone out there that is located in these high loan limits of Southern California, if your loan limits is above 726,200, then guess what? Your MIP factor goes up. Your MIP factor is 75 or your MIP factor is 70. That is a very important thing for everyone to understand because, again, this has happened on so many loans where a loan officer will call me and say, hey, I thought I was saving the borrower money and now I'm not. And it's like, okay, well, you went from a $600,000 loan amount to a $750 loan amount, and guess what? That MI factor went from 0.50 to 0.70. So again, obviously that is going to be much more geared for Southern California, for a lot of the people, Orange County, San Diego County, Santa Barbara County. Those counties do go above 726,200 for those loan amounts. Okay, so again, 0.50 or 0.55, you can get that from the mortgage statement as well. So when you look at the mortgage statement will have what their MIP is. So you can just know 0.55 or 0.50. You can, again, get that from the property profile, know what the purchase price was, know what the total loan amount was. You know if they put 3.5% down or if you know if they put 5% down, right? Are there any late charges on the mortgage? Okay, this is an important one too. The reason why this is important is because you get to add to the loan amount. So FHA borrowers, you make your mortgage payment after the 15th of the month, what happens? Usually the investor adds a late fee. Most borrowers that I know do not pay that late fee. They just pay their principal and interest payment, and then the late fee gets added on to their mortgage statement, right? Very common, probably more common now than what it was. Definitely more common now than what it was in 2020 and 2021. Why? Because a lot of borrowers are definitely making their mortgage payments after the 15th. And then, yes, you can then add those late fees. So I'm just going to say no for now. Are there any escrow shortages? Similar concept. Previous loan officer didn't do a good job. New build, right? They did a new build. They used a 1.25% tax rate. Now the new construction tax amounts like 10K higher. So now they have an escrow shortage. You can add that escrow shortage here by clicking yes, doing that there, okay? Is there MIP due? There is MIP due on every single loan, and it is always the same amount as the mortgage insurance, right? You have to pay mortgage insurance premium on that, so you can just basically add that in, okay? Pretty simple. Type in that information. Now, what is the borrower's proposed interest rate? Let's go ahead and just pick 6.25 today. What is the borrower's proposed MI factor, right? So I put this asterisk here. For the purpose of calculating the MIP, FHA uses the original value of the property to calculate the LTV. It's a big one. Your borrower put 5% down, okay? Now, they've only made 3 payments, so their loan went from 490 to 487. But now they're going to be adding another 1.75% on top of their loan because they're going to be doing a streamline. It is likely their MI factor is going to go from 0.50 to 0.55. Very rare. Obviously, it happens if the borrower put 5% down on their FHA purchase, which I guess can be possible, but theoretically, usually not. So do that. Fixed interest rate or ARM. What is proposed amortization term? 30. Will there be a lender credit? Please enter in BIPs. Let's just say there is a 1 point lender credit. Simple. If you want to do discount points, that's how you filter between the two. So actually, let's change that to 0.5. 0.5 lender credit. What is the estimated close date? Let's just go ahead and say we are closing 4/16, and our first payment date would, of course, be 6/1. Obviously, again, in this example, we know this loan would not qualify for a streamline, so ignore this concept. We're just kind of going through it. FHA streamlines is the MIP prorated each year with the lower loan balance. might be repeated here. What do you mean by that, Brandon? The upfront MIP or the monthly MIP?
So the monthly MIP, I thought FHA like
Yes.
takes every year it's going to be lower by a few dollars because of the lower loan balance.
Yes, you are correct.
Okay.
That's why you get the mortgage statement, but yes. So FHA Streamline, there are two different options. Okay. The system is built to tell you which option you need to go with, and then it'll spit down that information here. Again, option one is 100% better than option two. Option two will likely happen if the borrower is literally refinancing at the 6-month mark, right? If you close their loan in this example, it usually happens. You can see again, the max loan amount is important. These max loan amounts are very close to one another. It's because, yeah, I obviously didn't pull up the amortization schedule. I don't know if it was 487, so let's just put 488. Next thing you know, look, now we're going to option two instead of option one, right? So yes, the more payments the borrower has made, the easier it is for you as a loan officer. So we know there was a streamline opportunity in September of last year, about 12 days. 12 days, interest rates were pretty good. Wasn't a ton, so there's probably a lot of borrowers still on the sidelines. There's still a lot of borrowers on the sidelines right now that are waiting for this. So if any of those borrowers did their loan in 2023, Streamline will be 10 times easier than what it was last year. Okay. But if you are refinancing anybody that is at the 6-month mark, it's a little bit harder, and it's because you have a max loan amount. So simple. Just go ahead and type in today. Okay. The system brings over everything you need, right? You have your max loan amount. You do finance another 1.75% into this loan. It is 100%. Again, we know we all want to sell FHA loans because they have much better interest rates than conventional loans, easier qualifying. Personally, as a homeowner, conventional loans are infinitely better, and it is simply because you are not losing $8,000 every time you purchase and every time you refinance into your equity. Again, just my opinion, but there's that, right? So you do get an MIP refund, right? A lot of people think, oh, the MIP refund comes off of your old. No, that's not the way it works, right? You have your current lien, interest on the payoff. This is the big one, which I will get our programmer to fix this in the upcoming week, assuming the Fed meeting's kind to us. Interest on the payoff. You can add the interest on the payoff to this loan. We calculate the interest on the payoff at 30 days. There are several times where interest on the payoff will be 60 days, right? If that's the case, well, then we know the interest on the payoff is not going to be 3K. It's going to be 6K. If it was 6K, that hurts because that means your cash to close is going to go up $3,000 more. So again, I will try to fix this, but we default to 30 days at this moment. This is by far the number one thing that can mess up your loan amount. So that's answers the questions. Can I use the remaining original upfront MIP as a loan credit to offset the new unassigned premium? Again, you can use the remaining MIP to lower the new base loan amount. You cannot use the MIP premium, the old MIP premium, to offset any closing costs. It is solely for the loan amount. So again, we'll go into this MIP premium a little bit more here right now. So the number of payments made, 7, establishes what your MIP refund factor is. Okay. So at 6, it's a 0.70 factor. At 8, it's a 0.66 factor. At 9, it's a 0.6. At 9, it's a point, goes down by 0.02 every single payment being made. So essentially, this is a very important thing for people to understand, because if you do an FHA loan and you are scheduled to close on March 31st, and you don't close on March 31st and it gets pushed to April 7th, your entire loan changes. You then will have a different loan amount because your MIP refund factor will go down. The MIP refund factor, again, it's pretty simple. We did it for you guys here in the calculation, but the underwriter will get the MIP refund factor in underwriting. They will get it with what is called a refinance case authorization result. So with FHA Streamlines, your loan estimate is going to suck because your loan estimate will be $5,000 higher cash to close, because again, the underwriter does not get this $5,000 amount until the loan is in underwriting. Okay. Which, and again, technically that's not even necessarily true. The underwriter gets this case authorization result, and we've put a lot of stuff down here to kind of help everyone understand these things. Initial disclosures will not have the MIP refund on them. The reason being is the underwriter validates the MIP refund through a document called FHA case authorization. Click it. This is exactly what it looks like. Number of payments made does your factor for you, okay? This typically takes place after the loan is approved or at loan approval. In most cases, your loan disclosures will come out with significant cash to close as the MIP refund is deducted from the payoff after underwriting approves the loan. The only route is to have disclosures go without significant cash to close, assuming there's a large amount, would be to subtract the future MIP from the payoff balance in the liability screen. That takes some skill, that takes some knowledge. You have to go into your payoff, you have to lower your payoff by this amount. It's a little bit harder. Personally, what I do is I just use this estimate and I say, hey, your disclosures are not going to be correct. Use my estimate. My estimate is going to be correct, right? And then the reason where they get this MIP refund factor is they get it from either they need the previous. The reason why it takes place in underwriting is the underwriter orders this with the previous case number. So the underwriter needs the previous case number. What documents supply the previous case number on it? A note and or deed of trust, right? So if you have that, if you did the previous loan, then you have these documents. It's very easy. But if you don't have these documents, these are going to be conditions, and the underwriter needs these documents because they need the previous case number to pull this case authorization request. Case number is on the recorded document. Yes, case numbers are on the recorded documents. We don't pull FHA. We don't have access to FHA connection, Julie. That is the reason. We're not an FHA lender. We are a conventional MBA lender, so we just don't have access to it. Only the underwriters have access to that. Is the refi comp plan in place for UWM? The FHA refinance comp plan is not in place at this moment, Adam. We will go over that at the end of the call. So cool. Back into this. Underwriting fee, processing fee, right? For those who don't know, Secure Choice Lending lowers our processing fee to $395 on the corporate model. Obviously, because we know it is expensive for Streamlines and IRRRLs credit reports. You can use a soft pull, right? So you can use a soft pull. You don't have to use a hard pull for the credit report. Escrow, simple. Having your escrow fees be lower is a massive help. Prepaid interest. Again, everyone wants to close Streamlines at the end of the month. Why do people want to close Streamlines at the end of the month? Because your prepaid interest is going to suck. Then this is the big one, right? Homeowners insurance and property taxes. Homeowners insurance, you get the deck page from the borrower. If you don't know how to calculate the homeowners insurance, again, it's based off the renewal date. So again, if the renewal is in 5/1, we know we need to collect for 12 months homeowners insurance. If the homeowners insurance just renewed, then we only need to collect for 3 or 4. Pretty simple. You can just reach out to Help Desk. We'll help walk you through that training. If you don't know, just default to 7 or 8, right? Just make your life easy. It'll obviously pull the calculation from the previous homeowner's insurance. This is a big concept here, though. The system is going to pull it from the previous homeowner's insurance, right? Obviously, yes, the homeowner's insurance could have changed. If that did change, that would suck. But a system's going to do apples to apples. Property taxes, okay? As I mentioned on several calls, in California, April, in May is the absolute best time to do a streamlined and or IRRRL because you don't need to collect for significant amount of taxes. So we know taxes are due, again, exclusively to California. Your states, everyone, you guys need to evaluate, see where how much is going to add to the impounds. Taxes are due on April 10th. That means all the servicers have to pay those taxes by April 10th. If you're starting a streamline now, of course, yes, you can close that before April 10th. My suggestion, close after April 10th, close after the servicer pays it. Next thing you know, the servicer pays it. We only have to collect for 3 months worth of taxes, 4 months. That is by far the biggest closing cost of the loan. So again, it is the perfect time for streamlines and IRRRLs in California. Again, for other states, understand when your impounds are due, and that's essentially the month that it's going to fall on, has the ability to help you. This impound transfer, this is exclusively for servicer to servicer loans. So if you close a loan with UWM and you are closing a new loan with UWM, UWM allows you to transfer the escrow balance. Again, servicer to servicer. You cannot do it going from PennyMac to UWM. You cannot do it going from UWM to the loan store. Servicer to servicer. And then remember, even if you close the loan with the investor and then they sold the loan, you don't get to do it. So you need that mortgage statement because you need to know who is still servicing the loan. You can then transfer the escrow balance if you want. If you transfer the escrow balance, this has the ability to lower your closing costs. We're not going to do that in this example for right now. If you have any questions about the impound balance transfer, let me know. But let me know after. Simple. Now you have your loan types. We're going from 7.25 to 6.25. Your net tangible benefit, FHA, you have to drop 0.5%. We're dropping 1%. It is rate plus MIP. Remember that is a very important thing. Again, although rare, if your previous MIP was 0.50 and your new MIP is 0.55, guess what? That means you will not be meeting that 0.5 tangible benefit. So you need to do the combined rate plus MIP. Anyone that it's going to be very hard to find this, but maybe you'll get lucky. If anyone did an FHA loan prior to 2023, those MIP factors were 0.85. So again, that's not that long ago. That's 2 years ago. A lot of those borrowers likely refinanced in September of last year, but if they didn't, it is going to add to your savings significantly because all of those borrowers closed with a higher MIP factor and now they're at 0.50. So that will be a nice win for everyone. And then you have your monthly savings and you have your cash required at closing. So again, even in this example, even with the taxes being low, the borrower still has to come in with $3,592 at closing. It's why streamlines really, really work when you have about 1 point lender credit. The loan amount 100% matters. If your loan amount is $900,000, then you only need 0.5% lender credit, right? Because we know the fixed closing costs, right? You got $250, $1,400, like you got $2,000 to $2,700 in fixed closing costs between underwriting, processing. That's not going away. You cannot change that. That is fixed. You can only change this based off of lender credit, right? So now, if we have 1 point lender credit, is a huge win. Now the borrower only has to come in with $1,100, much easier sell. Again, bigger loan amounts. You don't need as much lender credit. Lower loan amounts, you need a lot more lender credit. So obviously it does play a major factor into that. We'll go over all of this here in a second. But now once your streamline estimate is built, you can just go to this print feature and it will have a estimate for you that you can send to the borrower. Personally, I don't do a ton of loans anymore. I would say everyone will probably agree with this. You get a 10 times better capture rate via text than you do email. Again, that's for me. So what I do is I simply screenshot this, my snipping tool, and I just draw arrows. Doesn't need to look fancy. I promise you, you will get a larger capture rate by texting them this than you will by emailing. Of course, you can email. I do both. You can then save it as a PDF. You can then email this to your borrower. You can then just upload this to processing because this is what it should be theoretically at the end. The only item that can change is this one. So yes, interest on the payoff has the ability to significantly change some things. So I don't have the ability to add more days of interest. So what you can do is you can pretty much just add some more days of homeowners insurance, add more days of taxes, inflate the closing costs that way, and then you can protect yourself that way if that's what you want to do to kind of do that. You do have the ability to save these scenarios. So again, I know a guy like Shane probably has 50 saved scenarios because now all you have to do is you can just save it, test scenario 7.25 to 6.25. You can now go to your scenario list and it is right here. So now you save all your borrower scenarios. You never have to go through this entire process of updating this over and over and over. You can just create a test scenario and all of these fees will default for you. And all you have to do is update these items now. Again, streamline your life. Use the tools at your advantage to kind of save things, to help with your borrowers. If interest rates aren't low enough, input it here, save it here. And interest rates fall, it's going to make your streamline estimates a little bit easier. Let's answer some questions. If the original loan was a 2-1 buy down, can I use the remaining buy down funds as a lender credit towards their closing costs? No. The original, if the borrower has a buy down and they have obviously not used their full buy down, that buy down goes towards their principal balance. That being said, that's a huge win still, because if you lower their principal balance, if you lower what they owe, it will allow you to inflate your loan amount to help offset closing costs. It's not a lender credit. It is solely based off of what their payoff balance is going to be. When saving scenarios, you only see your own. You cannot see everyone's scenarios. You can only see your own. If we don't roll the impounds, the borrower will get those funds refunded. Correct. Yes, 100%. That is a huge sell for everyone. Most FHA borrowers right now are just looking for a way to skip 2 payments and or get their escrow balance back, right? Depending on who you are as a loan officer, you can sell it. Hey, it's a mini cash out. I'm saving you $300. Sure, you're coming with $1,100, but you're coming with $1,100. You're skipping 2 months payments. So you're skipping, your old loan was $4,192. You're skipping 2 of those, $8,200, and you're getting your escrow balance back from your current servicer. In California, those escrow balances are not going to be very high right now. Why? Because servicers are paying those taxes right now. So yeah, $8,000 savings plus maybe $3,000 back from escrow balance, mini cash out. A lot of FHA borrowers are looking for that, and they get to save $300 a month. But yes, their loan amount obviously is going up. Don't just trust the servicer. We'll add the remainder of the temp buy down automatically to your payoff. 100%. Always do your due diligence. Make sure when that payoff comes in, you are seeing those funds being applied to your payoff. 2-to-1 buy downs, the 1-0 buy downs, things of that sort. Any questions on the estimate? And then I can kind of go in the submission real quick. Nope. All right. Submission checklists. You do this due diligence up front. It's a very easy loan. Mortgage only credit report or soft pull. This is investor specific. I think nearly every investor offers soft pulls now on Streamlines. Companies like SunWest, they don't even, if it's a SunWest loan, they don't even require a credit report at all. They'll pull an internal servicing history, things like that. I think the volume has kind of slowed down with SunWest, mainly because of UWM offering limited LLPAs on the low FICOs now. That's where everyone's going with that. Mortgage statement, homeowner's insurance deck page, recent utility, or pay stub with mailing address. This is a big one. It's a big difference between Streamline and IRRRLs. Streamlines require a recent utility bill or a pay stub. Okay. It is a non-credit qualifying loan. We do not care if that pay stub has $500 on it, $1,000 on it. The pay stub is simply to validate occupancy, right? It is an owner-occupied loan, which is why they require a utility bill or a pay stub, because guess what? You would never get your pay stub mailed to your rental address. You would make sure to update that to that. So that is why this is required. Copy of previous note. The copy of previous note is 100% required. A lot of people ask, well, can the deed of trust serve? The deed of trust does not serve. The deed of trust can help the FHA underwriter pull the case authorization results, but the previous note is 100% required because they need to know when the first payment was. They validate the first payment through the note. Payoff statement, that can be done obviously with processing. Title work, that can be done with processing, and then 1 month of assets. Assets are only needed. You only need to document assets if the cash to close is greater than the proposed PITI. So in this example, you do not need assets. Underwriter will not need you to source it because your cash to close is 1125 and your new proposed PITI is 3881. So you do not need 30 days worth of asset statements. If this was above this amount, yes, you do need to source assets. Okay. Some calculations for everyone. Credit qualifying guidelines. When a borrower is removed, you must credit qualify. I had this question literally at help desk yesterday. Hey, we're going to remove the borrower from the loan because they got a bad FICO score, but we're going to keep them on title. Can I do that? You must credit qualify if you are removing them for the loan. The whole purpose of a streamline is they qualified you at one point, FHA. Now you're going to have a lower payment. We believe we're going to qualify you now at the lower payment. If you're removing a borrower, that means you're removing income from the previous loan. That is when you need to credit qualify if loan fails HPML, certain forbearance cases, and then any streamline in Illinois. Illinois special state requires that. Mortgage lates. You are allowed one mortgage late in the last 12 months. You are allowed 0 in the last 6 months prior to the case assignment date. Technically, there are ways to lower these fees. You can 100% waive the processing fee. You can 100% waive the credit report fee. You can pay for the notary fee outside of escrow. Why would you do these things? Why? Because maybe this borrower's like, I'm just not going to do the loan. If the cash to close is 1125, I can do it at 400. Cool. You waive $800 worth of fees, you get it lower. Accounting will obviously then charge this out of your commission. This is not like, hey, we're just going to do that. That's obviously you basically giving the lender credit, because we know if that's FHA loans, if we were correspondent, everyone would just give that lender credit. We are not correspondent FHA, so it makes it a little bit trickier. How many days can you fund in the month? Big one. So again, as I mentioned, let's just say you close a loan on March 31st, but you don't close. You want to close it on April 2nd. Well, you don't want to have 27 days worth of interest be added, because you go from 4 days interest to 27, your cash to close is going to go up by $1,800. You can fund into the month up to 7 days, and you can have negative prepaid interest to help offset some of those closing costs. Assets needed, loan to value, common facts, 500 cashbacks allowed, no LTV caps. Yes, they allow FHA streamlines on second homes, and they allow FHA streamlines on investments. Even though I mentioned it's the owner-occupied loan, there are FHA borrowers who bought an owner-occ home, then moved out of that home. You can do an FHA streamline investment. Only certain investors will allow this, and they will 100% charge a pricing hit to do that, right? Interest rates are not going to be low enough to do that. Excess YSP can be used towards principal reduction. Note is required, as I mentioned. Cal HFA does not subordinate for FHA streamlines. We cannot finance more than 2 months of interest. Boom, boom, boom. And then obviously here is some rate and terms. So it's a big one. Streamlines versus rate and term. Obviously, you're going to go streamline because you don't want to credit qualify. You don't want to go with income. You don't want to go with assets. You don't want to do all that. It's a very easy loan. But sometimes you want to credit qualify. You want to do a rate and term. Why would you want to do a rate and term? Well, you want to increase the loan amount to help offset some closing costs. Streamlines don't allow you to do that. Streamlines have a max loan amount, right? Nothing you can do. It's a requirement by FHA. So you want to increase that loan amount to offset some closing costs. Or, as Lisa asked, maybe there's a silent second that you need to pay off. Going to be a little bit difficult, right? Because there is a max CLTV for this, right? And first of all, just so everyone remembers, you must wait 12 months to do a rate and term. Between month 6 to 12, it has to be a streamline. There's no option. Month 12, then you can do a rate and term. Okay, so a lot of people wanted to like, oh, I'm going to offset it. I'm going to trick the system. I'm going to do it at month 7. I'm going to inflate my closing costs. Not the way it works. Month 12. So max CLTV is 97.75. That's a very important thing. So yes, your appraised value needs to have gone up. Because remember, when you purchased this loan at 96.5 a year ago, your LTV immediately wasn't 96.5. Your LTV is 98 because we financed 1.75%. Over 12 months, you've paid down that LTV from 98 down to like 96.5, right where we started. Cool. Guess what? We are now refinancing and we are now adding another 1.75 to it. And we use the previous appraised, no, it's not that streamline. So obviously you need the appraised value to go up, and that appraised value can help understand the 97.75. Obviously that is for FICO scores above 580. Anything below 580, your max LTV is 90%. Okay. That is what I have for Streamlines. Any questions? Nice. All right. So we'll go to IRRRLs. We'll run through IRRRLs a little quicker just because that was pretty long.
Mark,
yeah, what's up?
one thing to add, just when you're selling these, until the underwriter does hop in the file, and hopefully you didn't say this already because I did get a text, but they're not going to have their MIP refund. So just remember that when you're selling it. You said that. I see your smile. Thank you. Bye. I'm gonna go back into my corner now.
No, we love it, Shane. You're right. There was a chance I didn't say it though.
I have a quick question. I don't know if you covered it too. Can you go over the difference between a simple refi and a rate and term FHA refi?
There's really nothing. Some investors call it that. I don't know why. Simple refinance and FHA rate and term are the exact same. Literally, some of them just call it simple refinances, like SunWest. They call it that over a rate and term. There's literally no difference that I've been able to find.
And I saw a question about it earlier. I don't know if you went over it. What about people that are using down payment assistance and there's like a silent second or something like that?
Yeah, I mean, unless that silent second's going to allow you to subordinate, which again, Cal HFA does not, which is obviously a very popular one here in California. And I don't think any silent seconds are going to allow you to, like, so the Windsor Zero Flex program or the URW Zero, like all these Zero Flex programs where basically they're just inflating the first interest rate to cover the second mortgage, and they're doing 2% above the note rate on the second. Zero of those loans allow you to subordinate. The whole concept of why they offered these programs is because they believed interest rates were going down at some point, and that in order for them to refinance out of it, they were going to have to pay it off. So basically, they were just trying to get purchase volume by offering these second notes in the hope that interest rates fell, paying it off. So, yeah. Yes, Steve, exactly. That's another one. Rate and terms allow you to pay off a purchase money second. So here you go, Brandon. FHA non-credit qualifying streamline. Can you pay off a second money? Can pay off like nope. So like it's just I don't think it's going to be allowed. You need to flip that to a rate and term, and you can pay off a rate and term with a loan. So obviously, main things just need the appraised value to go up. If you have a 10K silent second, you need that appraised value to go up 16, 23K in a year. Not impossible, but certain areas it's just not going to happen.
Awesome, thank you.
And Mark, before you leave that screen, on all these, which one do you have to wait the 12? I know you have to wait 12 months for the actual appraised value, but the final three you all have to wait 12 months or just the last two?
Final three.
Final three. Okay.
And obviously,
Mm-mm-mm.
again, the difference between rate and term and cash out, like, can you pay off delinquent taxes, things like that? You cannot do that with a rate and term. It must be a cash out. It's a very common one too. Borrowers haven't made their tax payments, things like that. So, yeah,
Well, if they have impounds, they should be making their tax
very,
payments.
very true.
Supplementals, though, supplementals.
That's correct.
And just a heads up, Mark, I've been tracking my buyers or my potential refis. UWM is keeping a lot more loans right now.
Love that.
They've had some for over a year, so
Perfect.
guns ready.
It's ready. Look, it's down a bit, right? Since we've been on this call, let's do it. All right, Earls, I'll run through this a little quickly. They are very similar to Streamlines, except they are 10 times easier. This is the easiest product in the entire industry, VA Earls. First thing you must do is you must wait 210 days from the first payment date. So yes, Earls are like a 9-month waiting period, because in reality, we all know the first payment date is a full month plus that. Like they're very long, right? So you enter in this information, it pulls in your LIN number, right? VAs have what's called a LIN number, loan identification number. You can pull that LIN number after the 210 days. Actually, I think it's closing. I'm going to confirm that. Trent, if you're on this call, let's make sure to confirm that if it's LIN number or if it's funding date. I actually think it's funding date. Like 99% sure it's funding date, not LIN number. Cool.
For what, Mark?
For the 210-day waiting period. I'm pretty sure it has to be funding after the 210th day, not LIN number.
No, you sign after the 210th day.
Closing documents.
Yeah, you can sign final loan docs on some lenders will actually let you sign on day 210, but the actual rule is 211th day.
Yeah. So it's signing, yeah, it's not LIN number. So you can start the application ahead of time. You just cannot sign closing documents until this time frame. Cool, pretty simple. It's actually less questions. VAs are a little bit easier. As I mentioned, obviously there's no mortgage insurance premium. There's no things like that. One of the big things to obviously highlight is the veteran, do they have disability status? If they have disability status, things like that, will they be exempt? So is the borrower exempt from the funding fee? Yes, no. If no, 0.55 VA funding fee will be financed into the loan. So I'm just going to put yes on this one. Very simple. Easy example. You can finance all of these loan amounts whenever you want. It's a very easy loan. The number one thing, so one of the big things here is this is where you can update the loan amount based off the cash to close. So let's just go ahead and let's inflate this. What does the borrower currently owe on their mortgage real quick to 500? So now the borrower has cash required to close at 866. Maybe the borrower doesn't want to come with 866. Well, then just go change this to 504. And now the borrower, did I go backwards there? Is that actually cash back? Did I do that backwards? Okay, I went backwards or something. I don't know what I did. You can change the loan amount whenever you want with VA loans, right? FHA, base, fixed loan amount. You cannot change it. One of the big things with VA is you have to meet a net tangible benefit. It does the calculation for you. 36 months. A, B, C, E. All of these added up together. Divide that by your monthly savings. And it needs to be less than 36 months. If it is less than 36 months, you qualify for a VA IRRRL. So again, very easy loan product, the best loan product out there. Difference between VA and obviously other than that, VA does not require a utility bill. VA does not require to validate occupancy. So the questions are less. One of the big questions that everyone always get, you can only finance 2 discount points. You'd only be, I mean, again, remember you can inflate the closing costs whenever you want, as long as they meet the net tangible benefit, right? So you put 2 closing costs in here. Now you have $10,000. Now the borrower has to come in. We're not passing net tangible benefit. So that's how it factors into this, but you can finance up to 2 discount points with the loan. That really will only matter if you are dropping the interest rate a significant amount. Other than that, pretty simple stuff. Exact same thing. You have the print feature up here. It'll have that availability for you. So
Mark,
Nice.
can you elaborate on you can only charge 2% discount points? Because there's a lot of lenders out there that are quoting IRRRLs with like 3 and 3.5% discount
Yeah.
points.
They're liars and it's bait and switch. You cannot. It's a
You cannot do that.
It's a VA guideline. It's just bait and switch.
If you go to the guides, you can pull it up. I can send it to you. But yeah, that's actually a great tool to have. And Mark, I'm glad you brought that up because yeah, when you see that, it's game over for you to build that rapport with your client. Sorry, I'll get back on mute.
No, I love that. You got
I
jump.
thought I was on mute.
Yeah, it's kind of the same concept, right? Why would you do that, right? Well, let's just say we're going from 7.25 to 6.25, and we're at 0 discount points, right? We currently pass net tangible benefit. So now we're going to add 2 discount points on. But why are we going to add 2 discount points on? Because this veteran wants a 5.125 interest rate. Cool. Closing costs went up a lot. And look, now we passed net tangible benefit because the savings went up to $654 a month. But now the borrower has to come in with 14K. So that's not the way it works. So now we have to inflate the loan amount up to 520. And look, yeah, we still pass net tangible benefit. The borrower veteran only has to come in with 578. Yeah. 2 points, just max. Liars out there, Jared. Liars. Anyone got any other questions on IRRRLs?
Back to not to hop around too much, but I just want to make sure I'm clear on how SunWest is pricing their loans. So like if we did a SunWest deal and it was a 580 credit score, are they just going to use 580 again?
They use a no credit score pricing adjustment. And if it's a SunWest to SunWest loan, they waive all pricing adjustments.
Okay.
Again, it is exclusive for SunWest to SunWest loans. It's a unique animal.
Yeah, got it. So no pricing adjustments whatsoever, SunWest to SunWest.
Correct. Yep. Should be no LLPAs from what I know. Obviously, if you go above 660, you should then use a credit score because you get a positive LLPA.
Yeah, got it.
And then do remember we changed our FHA comp plan for SunWest for portfolio loans. So for Streamline loans, SunWest to SunWest exclusively, our comp plan is not 250. I'm 90% certain it is 150. That is again exclusively SunWest to SunWest loans. I will double check and I will send that out after this, but I'm gonna go with 90% certain. Then I'll touch on other comp plans here in a second. Are we seeing any general rule for IRRRLs where we hope to see a certain rebate to make an IRRRL? No, I mean IRRRLs make sense whenever you want, Christina, just because again you can up the loan amount. Like, I guess again with Streamlines, you need that 1 point lender credit because then the borrower's cash to close goes up, and most borrowers don't. It's hard to sell a Streamline saying, "Hey, come in with 5K cash at closing," even though you can, because you can say, "Hey, instead of making your April mortgage payment, bring your April mortgage payment into closing." Right? It's the same concept. IRRRLs, you can just increase the loan amount, and that's what most veterans want. They just want to come in with $0 cash to close. So you can just do that. But in reality, the higher the loan amount, the easier it's going to be because your monthly savings is going to be significant enough to pass the net tangible benefit. If it's a lower loan amount, yeah, you probably might need a little lender credit because the lender credit would then help offset some of these fixed closing costs to pass net tangible benefit. So I hope. And then we will I'm gonna touch on the comp plan here in a second, but I just want to highlight to everyone again, life is moving fast, right? And like some of the stuff that we're trying to help build for everyone. So in a refinance market, And it kind of, this will tie into obviously the comp plan, right? Everyone wants to make 250, right? You know, on an FHA loan, or everyone wants to make 250 on an IRRRL or 275. Like, of course, most loan officers want to try and make that amount of money on it, right? It can become difficult. The competition is very hard, and the competition is only going to get harder over the next few years. And I'll just kind of highlight why. It's not going to be competition from a headcount perspective anymore. On last week's Wednesday market update, I highlighted that we lost 10,000 loan officers between March 1, 2024 and March 1, 2025. So the headcount perspective is actually down. You have less competition from a person perspective. You will start to have infinite competition from an AI perspective. So just kind of showing you some stuff that SCL is building. We're hoping it's ready over the next few months, you know, but now you'll be able to come here. You'll be able to launch your AI dashboard, right? You launch your AI dashboard, it's going to have your closed loan pipeline in here, right? You come to your closed loan pipeline, it will have today's interest rates. Today's interest rates will be called based off of a 200 basis point margin, something like that. It'll be, again, a company defined interest rate where we believe that's where majority of loans will sell out. Doesn't mean you have to sell at that interest rate. You can absolutely sell it. It will then tell you what the rate reduction is. So then you can start to filter, hey, I got borrowers that are 1% interest rate. It'll help you filter a lot of these loans. You can then update your statuses on if they're converted, not converted, things like that. But in reality, again, what you're going to be able to do is you're just going to be able to hit build estimate. And then once you build the estimate, it'll have the amortization schedule already built. It'll have the VA, you know, when we highlighted this, when you do these questions, a lot of it's this previous loan data. Well, if it's a loan that you've already closed, we're going to have all this information. So then what do you need? You need the proposed interest rate. Well, as I just mentioned, I can pull an API and I can tell you what today's interest rates are. I don't necessarily need you to tell me what today's interest rates are. An AI can do that now, right? And then all these other things can just be financed, right? You can basically tell the AI to do certain things. And then once you do that, you just build these estimates and it'll do it for you. And what we'll be able to do is everyone will be able to save their own default savings. You know, everyone has their own title companies. Everyone has their own escrow companies. Some people's title companies charge this. Some people's charge that. You'll be able to default your savings. And I mean, I'm just highlighting this, that we are building this. You don't think Lakeview, you don't think all of these other current servicers are building this as well. And then in reality, you'll be able to just come in here and it will just have the estimate built for you. And you can just hit send estimate to borrower. And then again, it will have more than that. It will have scripts built for them, you know, based on today's interest rates. Here's current monthly payment, potential new payment, monthly savings. This is what your escrow balance is. All of this can be done, right? And all of it is currently being worked on internally by us. We're doing it for all of your benefits. We want everyone to get as many loans as possible, okay? Because obviously we are a company that is purchase centric and we only close loans. We don't service loans. We don't get paid by servicing. But Lakeview, how do they make money? Through servicing, through retaining all of these loans. So if you don't believe they're going to do everything, every single thing in their power to retain the servicing, well, they can build out all of this. You don't really need, you can pay a loan officer 35 basis points. All you have to do is be able to answer calls because the AI will be able to build out all of these templates for them. And guess what? If you're paying a loan officer 35 basis points, that's going to increase that interest rate or decrease that interest rate a drastic amount. So I'm just highlighting this type of concept for everyone to understand that I want everyone to make 250 on every single loan, right? 300, whatever. I don't, you know, we obviously have a max margin, right? Everything. It is only going to get difficult. And that's with loan officers coming down because technology is infinite now. And not only is it infinite, it is working 24/7, 365. So while you are sleeping, it can build this estimate, right? And this isn't fully done on our end yet. Give it another 3 years. Give it another 5 years, right? I think we'll be ahead of the game. We will have all this built for everyone within the next 3 months, 6 months. Lakeview will have it built in 3 years. And then once it's done, that's when the competition gets aggressive. So purchase is very important. And also not only that, being in front of your clientele base. Again, our CRM will be ready. April 8th or April 15th. We're going to have a Tuesday call on the CRM, either April 8th or April 15th. Staying in front of your database is incredibly important. Being not only a loan officer, but being a financial guru, understanding the market. Why am I so big on loan officers needing to understand the market? You need to be able to have those education calls with your borrower. Do you believe interest rates are going to fall? Do you not believe interest rates are going to fall? What is happening with inflation? You need to be the liaison. The days of just knowing people are gone, obviously, unless you have that Joey-esque type of sphere of influence, right? It is difficult. You have to understand each and every aspect of the industry because things like this, where it was difficult, is now going to become unbelievably easy. On a VA IRRRL, what is the limit we can raise the loan amount? No limit. You can raise the loan amount as much as you want, Jimmy. You just have to qualify for net tangible benefit. That's it. So that is what I have. And then on that note, so again, for anyone that was here in the past, we did lower our FHA comp plan exclusively for refinances, not purchases. One of the negative parts is, again, we can't do it for streamlines versus cash outs, right? We would love to do that. We will likely be doing it again. We are going to wait until after tomorrow's Fed meeting. Remember, we participate in that with you. So if we lower our comp plan from 250 to 175, you're like, wow, I just lost 75 basis points of my commission. I get it. It is going to be very hard for you to get these streamlines at 250. We are trying to help you get these loans in general. It is better to make 90, 110, 115 basis points on these loans. Again, we will participate with you. I will send this out via email. Again, it is 100% going to be dictated on the Fed meeting tomorrow. If the Fed meeting's bad and interest rates go up, I'm not going to do it, right? Because it's not a lot of streamline opportunities out there. This chart is screaming lower to me, so I think it's going to head lower. Again, if you're at 175, it goes to a percentage-based model. We participate. We will cut our commission. So you guys cut. We're all cutting our commission together. So then, even if you're making 100, 110 basis points on a $400,000 loan, that is better than losing it to Lakeview. So stay tuned. Again, that'll be TBD based off of tomorrow's Fed meeting, based off of what interest rates do. But again, just highlighting why we do those things. Okay. Anyone have other final questions they would like to ask?
Hey, Mark, I just reiterate, you're right on the mark with the Lakeview and all the largest servicers. They don't actually pay loan officers like we're used to thinking. So we had a servicing runoff team at Loan Depot, and they paid them a minimum wage on these types of loans because they're so easy to execute. Basically, they just gave them a couple of check sheets and ask the borrower these questions and get those answers, and then each one of them led down the page to the bottom result, and they moved on forward. So if I know it's never fun to give up some commissions, but getting the loan and making something is better than not making anything, because there's still going to be competitors out there that are even at 175 or 150 that are going to be significantly lower. So I think it's a great plan. Thank you, Mark.
Sure. Very cool. Anyone have any other final questions? Cool. All right, we will leave this here. Maybe if interest rates fall, we'll do another Streamline IRRRL, mainly from the sales aspect again, but we'll wait and see how that plays out. It'll be different from a Tuesday call, maybe like a Thursday call for anyone to join. So enjoy the day, everyone, and reach out if you have any questions.
Hey, Mark, real quick.
Yeah, what's up,
Can you show us if somebody wants to make like an extra $100 payment, where is that on the dashboard? Like where don't you have like a calculator for that?
No,
at
we've
SCL?
never.
Oh, you guys didn't do that?
Yeah, I can build that though, because you can see we've this will hopefully all be available soon where you can, expanded buy down calculators. So, we're doing a lot, just not available yet. I will add that one into this. If you make an extra, basically, if you make more of your principal payment,
Well, like,
will you pay off your loan?
yeah, like I mean I have like an app that'll show it, but I'm trying to get it to a client where like, hey, you make $100 more a month, your mortgage goes. Does anybody have like a link so I don't have to go look, or something that they use where, hey, if I make $200 more a month on my payment, I can pay it off this much faster?
Hey Shane, if you download Carl's mortgage calculator,
Yeah.
that's Carl with the K, you know you can send that, right?
Oh, you can? No, I didn't know
Yeah,
that.
you can share it. I share it all the time.
Yeah, I love that. That's the best app. Carl's with the K. Best.
Yeah, so
Best.
use that. You already
Okay.
have it. You should know you can do it.
I did not. I know. I just found out if you scroll down, you can have that feature to show like, oh, more or less in the payment. So yeah, I'm learning the tool, but
Yes.
yeah, it's awesome. Thank you for
Send
sharing that.
send me the calculator
Yes.
sheet if you
No,
can.
Mark.
I'm just gonna
Nope.
build it.
What? I'll send it to you.
We're just gonna build it in here.
It's an app. It's just an app. Carl's Mortgage Calculator. Oh, you have an Android. They might not allow that on that one.
Hey, I was just looking at it. The menu setting on the right-hand side, it says email report.
Oh, yes, it does. Look at that. We need one that says Mark's Mortgage Calculator.
No,
Make it better.
all branded teaser. Like here, profile settings, boom. Enter in your own settings. All be done for you. So
And Mark, did you say 1.75 was confirmed for UWM or 1.5?
if we make the decision, it will be 1.75 is what we will go with.
And then are we still looking for an alternative route too? Like, are
Over
you
the
just gonna do?
175?
No. I'm just saying, like, with another lender, are you just gonna do it with one, like UWM?
Just one. Let's be
Okay.
real, no one wants to go through max loan amounts with all these other investors. Like, yeah, no, just one UWM 175. Hopefully, Pal's kind to us. See everyone tomorrow.
When does he talk today?
He talks
20 minutes?
tomorrow at 11:30, I believe.
Oh, okay. Yeah, screw that guy.
Okay. See you guys later.